3 years. It's all the time many people have before they walk away from a paycheck they've depended on for decades. Here's what surprises me. Most people spend those final 36 months, 3 years, trying to save a little more money. But the people who retire with the most confidence, they're making completely different decisions. 3 years out, they're now thinking how to optimize taxes. They start to build some cash reserves. They start to stress test the retirement income strategy. They're making healthcare decisions before they become expensive mistakes. And they're answering one question almost nobody asks. Can I actually enjoy retirement without constantly worrying about running out of money? So today, I'd like to walk you through the 7 most important decisions you should make during the final 3 years before retirement. Missing just one of these, it could cost you thousands or more over the lifetime of retirement. And it also can make retirement far more stressful than it ever needs to be. So let's start with the one that almost everyone gets wrong. And so decision number 1 is to know your income gap. Now, if you watched this channel before, you've heard me talk about the income gap. That's because I believe it's one of the most important numbers in all the retirement planning. Yet very few people actually take time to work through the math and calculate it for themselves. Now here's what I mean. Most people know roughly how much they have saved. Maybe they know they have $1 million saved at $700,000. Maybe you've saved $2 million. But that's not the key question here. The real question becomes, how much income will I have guaranteed from places like Social Security, maybe pension income, maybe very reliable income like a rental property, or even a guaranteed income stream from an annuity. So those are the sources that we can look at as far as guaranteed sources to carry us through retirement, and while also looking at our liquid assets. So let's use an example. Let's say our retirement spending is expected to be about $8,000 per month. We add up our Social Security, it's our guaranteed source, and it's $4,500 per month when we start it. Now, your income gap in this example would be $3,500 every month, which is $42,000 a year. Now, this is what your investments, your liquid assets, will need to allow you to withdraw to sort of produce this level of cash flow to offset your gap. So now compare that against your liquid investment assets. And this is a simple calculation that tells you far more than just comparing yourself to national savings averages and those sort of things. It's one of the most foundational ideas behind the book that I wrote, The Retirement Planning Blueprint. Because it's about understanding what you own, what you'll spend, understanding your guaranteed income, and then the remaining gap before making investment decisions. So without this number, everything else is guesswork. Retirement shouldn't be built on a bunch of guesses because that leads to no confidence in retirement. Now, if you would like help calculating your own retirement income gap, that's exactly what we help families do every day at Cornerstone Wealth Planning. And there's a link below where you can schedule a conversation if that would be helpful. Now, decision number 2, build your retirement cash runway. Now, here's one mistake that I do often see over and over for folks looking to retire. Someone retires and the market drops 6 months later. Now they're terrified, not because their plan has failed, because now they realize they'll be selling investments during a bad market just to pay the bills. This was something that could have been avoidable. During these final 3 years before retirement can be the perfect time to start building cash reserves, or at least putting something in places that have lower risk than stocks. So think of it as creating a paycheck replacement account. This is also known as a bucketed strategy that we often talk about. And so if you look at it this way, maybe it's setting aside a year of expenses, 18 months, 2 years. And it all depends upon your overall financial plan. Now, this isn't because we want cash to earn great returns, because that's not really the way cash works. But cash gives us flexibility and optionality of where to pull from. Because when markets fall, we need to know our paycheck will continue. Now you're writing this to yourself. It's your paycheck coming out of the bucket that's set aside to help you with short-term volatility. Now, this tends to change everything psychologically. Instead of just asking, what should I sell this month? What's maybe not down as much? You're able to sell from assets that maybe haven't lost because they're set aside in much safer sort of investments. You already know where next month's income is going to come from, and that confidence is worth a lot. Brings us to decision number 3. Use your final working years wisely for tax planning purposes. So here's something that most people don't realize. Your last few working years often determine how flexible your taxes will be for the next 30 years. So think about what's happening here. You're still earning income, likely your highest income years. You'll probably put money into retirement plans. You may still receive some bonuses. You're deciding whether to retire now or delay it by a few months or even years. And so every one of these decisions affects future tax planning. But here's the interesting part. Sometimes the years immediately after retirement, now paychecks stop, but this is before required minimum distributions have begun in your mid-70s. It's before you've claimed Social Security. Some of these years are your best tax planning years that you'll ever have. These are years when maybe you could do strategic Roth conversions. You can actually isolate and have capital gain tax management at very low rates, even 0%. Or just income-wise, you could strategically fill lower tax brackets and use funds if you need to. Now, the point isn't that everyone should just go out and convert retirement accounts or sell things for capital gains. The point is this: you should know your tax strategy before you stop working and not afterwards, because you want to do things now that plan for that period. Because once certain opportunities disappear, they could be gone forever. This brings us to decision number 4. Be sure to have a health care plan before we actually need one. Now, this one can catch people by surprise, especially if they're retiring before age 65, which is usually the Medicare eligibility timeline. So suddenly, health insurance becomes one of their biggest expenses in retirement. Many people simply assume they'll figure it out later, but that can be quite risky. Instead, use these final 3 years to understand what coverage you'll use, how much premiums may cost, whether your income in retirement can impact or provide Affordable Care Act subsidies, how healthcare spending may change once you get onto Medicare, because this isn't just a health insurance decision, it's a cash flow decision. It's a tax decision. And often it's an early retirement decision. Now, the earlier that you model something significant as this, the fewer surprises that you'll have later in retirement. Bringing us to decision number 5. Decide your Social Security strategy before you retire. Now, here's what many people do. They retire, and then they ask really important questions around Social Security. They say, should I file for Social Security? That's often looking backwards. Now, Social Security decisions should often be made in light of all other planning areas. So before you retire, you need to ask better questions around Social Security. So with Social Security, you must ask why questions, because claiming affects everything else. So why are we choosing this strategy over this strategy if we look at it in light of portfolio withdrawals, taxes, survivor planning, spousal benefits, and even Medicare premiums that could be increasing based on the total amount of income. Now, sometimes delaying benefits can create tremendous long-term value. Other times, claiming early can actually make some sense, especially if health, work plans, or income needs are different. So there's never one correct age. There's only the age that fits best into your overall retirement plan. So the mistake isn't claiming at 62 or 67 or 70. The mistake is claiming without understanding the trade-offs and how and why it affects everything else in your financial plan. Which brings us to decision number 6. Let's simplify your financial life. Now, I've noticed something interesting. As retirement approaches for people, they usually have many more accounts than they ever realized. What do you typically see? You see old 401ks when you start to really put things together. Maybe you have several IRAs. Maybe there's a brokerage account or two, some bank accounts. Oh, there's some old company stock over here. There's even some old insurance policies that we haven't looked at for years or decades. Now, retirement is really a wonderful time and opportunity to simplify and maybe consolidate things where appropriate, but certainly to simplify. You should review beneficiaries. You should update your estate documents. You should evaluate whether the current house that you're in supports the retirement lifestyle that you actually want. And sometimes staying in that house will certainly make sense. Other times, maybe it's downsizing for flexibility or moving closer to family, kids, and grandkids to improve quality of life more than increasing your retirement portfolio ever could do. So, retirement isn't just about maximizing wealth, it's about maximizing life. Which brings us to decision number 7. Give yourself permission to spend. And this often is the hardest decision of all, especially for folks who spent 40 plus years saving. And many retirees are excellent savers, but they are the world's worst and terrible spenders. Not because they can't afford retirement. They're not used to this type of environment where now they're spending. They're used to just saving. It can be because they're afraid. Maybe they're afraid of running out of money. Maybe they're afraid of spending what they've worked so hard to accumulate. But this is why we want to spend so much time creating written retirement income plans. Because confidence doesn't come from having just a certain account balance. It comes from knowing where your income will come from, how your taxes are managed, how healthcare fits into your overall picture, how your investments support your withdrawals, and seeing that entire picture working together. So when you've connected those dots, you can stop asking questions like, can I afford this vacation? And you can start asking other questions like, is this the life that I've been working towards and wanting to retire to? And that's a very different retirement answer. So if you're within about 3 years of retirement, don't think of these next 36 months as simply the final stretch of your career. Think of them as the construction phase of planning and working towards the next 30 years of retirement. The people who retire with confidence usually haven't accumulated dramatically more money than everyone else. They simply made better decisions before they retired. They understood their income gap. They planned appropriately for taxes now and in retirement. They prepared for healthcare decisions. They coordinated their Social Security decision. They ended up simplifying their financial life. And perhaps most importantly, they've built a retirement plan that gives them permission to actually enjoy retirement in the decades they spend ahead. So if you'd like help pulling all this together, that's exactly what we help clients do at Cornerstone Wealth Planning. So our team includes many certified financial planners, a CPA, an enrolled agent with the IRS, and even an estate planning attorney who helps clients understand and put together integrated retirement plans. Because it's not just about investments and an investment portfolio, but it's about looking at things comprehensively, integrated, and making the best decision in light of everything working together. So if you'd like help looking at your own situation, please click the link in the description below, and we'll be glad to schedule a complimentary strategy call with you to go over this and to talk about your retirement. So thanks for watching, and I'll see you in the next video.